Okay, and we basically going to be looking for price action at areas of support and resistance. So time frame breakdowns. We're going to look at monthlies, also known as AMRs or acute monthly reversal candles, weekly formations, daily, 4-hourly, 1 hour, and what I call noise, which is basically all the way down into a 5-minute time frame. So first, a monthly. Okay, so we're looking at areas of support and resistance. We're looking for breaks of support and resistance. We're looking for confirming candle formations. We're looking for chart patterns. Here we can see an area of support. We break the line of support, and then we constantly make these lower monthly highs, okay, as we move down. We then get an inside Arami candle. Basically, an inside Arami or an inside candle shows investor indecision, okay? It's neither taken out the high or the low of the previous candle. And then we basically want to be looking for a break of the previous candle to confirm that the trend has changed. So here, the break is of this candle, and it then moves up to the upside. Okay, rejection of a previous high, again, an area of resistance. I wouldn't expect traders to trade off monthly candles, but there was a report that I read quite some time ago now, where a guy basically broke down in one lot, trading 4 different currency pairs, and all he did was take the acute monthly reversal candle and changed his bias, or reversed his position if he got an acute monthly reversal candle. I think out of the 4 currency pairs that he covered, he had 36 trades, and out of those 36 trades, I believe the win ratio was about 25 winning trades. So they're not to be ignored. Basically, the higher the time frame, the more relevant the candle. Okay, and that's why when I was talking previously about the 5-minute or 3-minute time frames, unless you're scalp trading, it's noise. Okay, you get your bias off your larger time frames, and you want to be trading with that bias. Okay, so here, just getting back to this chart, we've got rejection of previous highs, moves down again, and again we get this inside candle, or this investor indecision candle. Break of the high, market moves up again, inside hammer, and then back down towards this trend line. Now this formation, it's not a symmetrical triangle. It's not an ascending triangle formation, but it is a period of consolidation. Weeklies. Now, weekly candles I do take a lot of notes of. Okay, I'm always looking for reversals or continuation patterns. I think a lot of novice traders or intermediate traders are constantly looking for the market to change direction, so they're constantly trying to pick the bottom or pick the top of trades or trends. You're far better off waiting for the market to confirm that the trend has changed, and then to jump onto the trend. We've all heard the saying, the trend is your friend, but it is until the trend is over. So we want to be looking for these continuation reversal patterns in the different time frames. So here again, bullish engulfing candle at the base, which is obviously where we want to be looking for them. We don't really want to be seeing engulfing candles in the middle of a trend. If they are, they're a continuation pattern. So here, bullish engulfing pattern, moves all the way up to a bearish engulfing. Again, down to the previous area of support. Here's our area of support here. Spikes through the area of support, and then gives us a bullish engulfing pattern after a doji. Okay, market then moves up. You can see here this was a previous area of resistance. Okay, we've got rejection of highs, pincers or chopsticks. Not really a great can't understand the rejection of lows. Here, this is a candle in any time frame is not complete until it's closed. So even though it spikes through this area, this base, this long spike is a rejection. So basically the market moved all the way down to this low, around 157.50, and then the market refused. Buyers came in and pushed it all the way back up. It closed up around here, but around 161, higher than 161, probably around 161.50. So it's a rejection of the lows. It's a rejection of this previous area of support. If we drew an imaginary line across here, we can see that all these areas, the market has failed to break through. And again, it fails to break through. An area of support, as long as it holds, is still an area of support. As soon as it breaks, it then becomes an area of resistance, which we'll see in shorter time frames. So this was an area of support, came down, rejected the lows, gave us a bullish engulfing candle, then moved up again, pincer tops. So areas, the market moved up again towards 166.50, rejects the highs twice, and then moves lower. And again here, we've got an area of support, which was our previous low. And again, spiking candles, pincers, rejections of the lows, and then we move up. There was no reversal candles here. Even though this is a decent warning candle, because it has taken out the high of the previous candle, and it's taken out the low of the previous candle, but it did reject. It obviously needs to close down below the open of the previous candle to obviously fully engulf. A lot of analysts or textbook engulfing candles will say that just the body has to engulf the previous body. Okay. What I like to see is the whole of the candle being engulfed. Okay, so I want to see the whole of the range taken out. Because basically what that then dictates is the market moved higher. It did make a previous high, but then it completely reversed its attitude or its sentiment, and it took out the low. So it completely engulfed that candle. Okay, so it's virtually the opposite of an inside candle, where obviously an inside candle is indecision, where the market can't make its mind up which way to go. An engulfing candle, the market continued in the original trend, be it up or down, and then completely reversed and went in the other direction.